Hi everyone, welcome to BlockDown. I'm Kristina managing editor at Cointelegraph, and we are here at a wonderful, exciting debate between Ryan Selkis and Kain Warwick, and we will be talking about DeFi. Bull versus bear, bear versus bull. Guys, I don't know when exactly were you invited to this panel, but since then I imagine a lot of things happened. So we had a kind of a big crash in the beginning of October. How did the sentiment change around you, and also your own impression and sentiment about the market? How did it change since October 8th? Let's start with Kain.
Sure. So, I mean, it's actually been a bit nice, right? If anything, things have just calmed down just a little bit, right? It was a bit intense for a while there, I think through August and September. So it does feel like we've been able to kind of, refocus on what we're building. I think people have kind of enjoyed a little bit of a reprieve from the madness for a few weeks. So I don't think it's the worst thing in the world to to have a little correction and just kind of tamp down a little bit on the enthusiasm.
Right?
Yeah. So when we agreed to this, I was the bear, maybe because no one wanted to actually take the bear side. I should say that there is a lot about DeFi that excites me long term. But for a bit of context, in 2013 when I first got into crypto, I thought things were overvalued, but that ultimately the bull run was going to catalyze interest in digital currencies and ultimately lead to a build out an infrastructure. That played out in 2017 during the ICO bull run. It was obvious to many in hindsight, but to some of us that were kind of on the inside track, that 99% of the tokens that were issued and that were trading at crazy valuations were going to end in tears. But again, the capital had been raised and many good teams were assembled and recruited into the industry, thanks in part to that bull run and that mania in 2017. And of course, there was a washout, and now we're starting to see the fruit of that last cycle, including projects like Synthetics, some of the decentralized exchanges, and some of the other early DeFi applications actually come to market with sophisticated ecosystems and actual real use cases that do have long-term merit. But once again, DeFi is kind of in that super cycle or in kind of manic phase of the cycle. At least it was during a portion of the summer. We'll see if there's another leg up to really get crazy towards the end of the year, or if that was kind of the high water mark for this particular cycle. But like 2017, like 2013 before it, it's obvious that there's not much sustainability to this type of growth in DeFi. And what I mean by this type of growth, I'm talking about things like yield farming, where it's tokens all the way down, right? So the only way to actually earn return within this ecosystem over the summer has been to be an early participant in one of these liquidity farming games that ultimately reward you not just with interest or network fees, but ultimately native tokens that people have bid up with the intention of either staking them and earning more, or basically participating in a de facto Ponzi scheme. And I don't mean that disparagingly, but at some point when people stop wanting to play the game, the markets unwind, and that's what we've seen the last few weeks. So I'm a long-term bull, believe it or not, based on that entire commentary. But it's been pretty obvious to me. It's going to take a bit to get people excited again about DeFi assets now that they feel like the game is up. And it's not quite so clear that they're going to make gobs of money versus 5-10% interest rates or honest living in an otherwise risky sector of the crypto economy and in general.
Ken, and what is your take on yield farming? Like, did it add any value at all to DeFi, and what it actually says about a sector when the thing people rave about is printing new tokens with some very clear Ponzi dynamics?
You know, I mean, we were partially responsible for some of this dynamic, right? I say we to avoid being me, but like our community was a big sort of catalyst for this, and ultimately what it comes down to is incentivization, right? It's a new way of distributing ownership of these networks, right? And Ryan, you pointed out in 2017 that the token distributions oftentimes, irrespective of like the capital formation component, it was tokens being distributed for things that were nonsense, right? Like most of the time, right? And I think the big difference here is, yes, you had some food clone Ponzi things, but even when you look at systems like Yam, Pickle, et cetera, like they do have a component of reality to them, where they are trying to do some action. They're trying to coordinate something for these players to come together to do. And so I do think we are in a very unique moment in the crypto hype cycle, where we've never really had a situation where we've had these kind of blow off tops or irrational exuberance that's so rapidly left behind like genuine things, right? Like 2017, like you look at like Feb 2018, nothing is there, right? Like basically nothing, right? Like there's like Maker and like two other things that were actual like sensible projects, right? And I think that today, what got people excited about DeFi is still there. The crazy frothiness, the food coins and everything, it's kind of faded away a little bit, but like Uniswap's still there, Curve's still there, Synthetics is still there, Balance is there, Comp, like all of these different protocols are still there, they're still working, they're still functioning. And so I think that there's a chance for this cycle to actually be much faster, where, we had this craziness and then people kind of, wake up the next morning and it isn't just like ruins, right? Like there's actually stuff remaining. So I'm hopeful, and I really, as someone who's been in crypto for a while and seen these cycles play out, I'm hopeful that we don't have years to wait for people to kind of realize that there's actually stuff here. I think it could be a shorter turnaround time this time.
Yeah, I don't disagree with that. I think the benefit that Synthetics had, the benefit the Compound had, and that first mover advantage, I think was really key in this particular area of innovation, because the value in yield farming and this kind of novel participatory network design, once it became obvious that was a smart way to bootstrap a community, the only thing that other projects did was accelerate the incentives. And when you accelerate the incentives, it's indistinguishable from an outright Ponzi scheme. And so I think that was kind of the excess of the market. What I think will be interesting, and I do agree, maybe for a slightly different reason, that Kain's right about the potential speed of rebound here. And it's actually because of the sophistication of stablecoin infrastructure now, right? In 2018, Tether was still the only game in town. Maker was just coming online, but was very, very much unproven. And you could argue it took, maybe a full year of Ethereum unwinding, 90% to really prove that Maker would be resilient and DAI would be resilient as a synthetic stablecoin. That infrastructure is much more robust now. And you've got a whole spectrum of stablecoins that allow people to actually move in and out of these decentralized finance applications and not take principal risk with kind of the base currency. That I think is a game changer, because now you'll have a slew of insiders that might be able to participate in these DeFi apps and actually, unbank themselves, for lack of a better term, because they know that they can earn 10% interest, 15% interest, even when some of these yield farming rewards come down. And it will be relatively sustainable. And that's, if you can get comfortable with the smart contract risk and you're sophisticated and you actually trust these systems, it's a hell of a lot more compelling than just sitting on a pile of cash, whether it's in a trading account in crypto or in a US bank account. So that I think is the really interesting difference between these couple of cycles. And what I might compare it to historically is, in the US at least, it's like the grayscale premium, right? If you're going to be invested in the industry anyway, and you have access to the grayscale products, you might as well invest in those underlying, sit on them for 6, 12 months, and then sell them, basically recycle the premium. And that's just kind of another form of implicit interest. That, I think, could accelerate a rebound for the blue chip projects, not for most of the also-rans.
So you consider the market being more mature now than during the ICO boom several years ago?
I mean, like, just obviously, right? Like, it's not like,
yeah, okay, well, I mean, let's elaborate a little bit. What remains the same and what is different now?
I like it's a bit of a joke, right? Just because I think for those of us who like lived through that, like it was so ridiculous, right? Like, so, there was so little substance, right? That like, now like anything would be better. And I think what we've got is not just anything. I think that it's really, a nascent ecosystem that is functional, right? That you can participate in, it works, it's the yields, even if you abstract away and just, completely ignore the kind of seniority yields of like, your access to the network itself, and you look at just the real yields, we're still seeing trading yields, lending yields that are in high single digits, right? And which, that's very, very good compared to the macro landscape. And, something that you said, Ryan, I think, that is going to make this whole process even more interesting is you now have this new narrative. We've been waiting for institutions to show up to Bitcoin for a long time, right? And all of a sudden they seem to be starting to show up, but not in the form that we're expecting, where you have these public companies that have huge cash balances that are all of a sudden starting to allocate it to Bitcoin. Personally, I didn't see that coming. I haven't really heard of that as like a thing. We were kind of expecting it to be, public endowments and stuff, investing in Bitcoin as a kind of a way to get some, capital appreciation, rather than protecting cash balance that, when you run out of shares to buy back or whatever, you've got to just throw some of your, billions of dollars in cash into Bitcoin. And I think that if that narrative plays out, Bitcoin can lift all of crypto, right? Like Bitcoin is still, in spite of stablecoins and everything, it is still the most important cryptocurrency, by a long, long way in terms of brand awareness and everything. So, if Bitcoin has a resurgence and we do see some crazy price action in Bitcoin, I think that could bring people back into all of crypto, which, DeFi could benefit from as well, which I think didn't happen this time. I think that it was genuinely like a DeFi related market cycle that kind of had nothing to do with Bitcoin in the last like 6 months.
Ryan, do you agree that it's not reminiscent of the ICO boom so much?
No, well, I mean, it wasn't, it hasn't got nearly as crazy. I think even the top DeFi applications and those tokens didn't clear, a $1 billion market cap, or if they did, it wasn't by much. It was very, very short term. Whereas, if you look back, again, 2 years ago, Dogecoin hit $1 billion market cap on January 3rd of 2018. And that was the 35th asset that was $1 billion at the time. So it was absolutely insane, right? In terms of valuation. In terms of infrastructure, the infrastructure wasn't there to support investment, but it also wasn't there to regulate the top, right? And so there wasn't really any way to short the market at that time. And so you can kind of question whether the market prices were actually reflective of reality. And in fact, when I was talking to my co-founder about starting Masaru, the only reason we didn't start a short fund, an activist fund, in late 2017 was because we didn't trust the data we were getting from the exchanges. So didn't really have a way to reliably short or to actually secure some of these tokens to short. So I think in that sense, the pricing that you're seeing is more reflective of reality today. I just think that by and large, there's a ton of competition for how to support these different assets and how to make all these markets much more efficient. I did a demo a couple months ago where I created a small random liquidity pool that was intentionally mispriced in Uniswap, And it was arbitraged within about 30 seconds. It was actually arbitraged as we were talking about it with Hayden from Uniswap. And we caught it live. It was fascinating. So, the people are watching, they're paying attention, they're making the markets. And there might be some blow up risk with the kind of integrity of the contracts themselves. There might be other ways to attack these things, but these systems are much, much, much more robust than they were in 2018. Because 2018, 2017, they weren't software. They were white papers, and pretty shoddy ones at that.
You mentioned regulation, so surely the SEC has an eye on the DeFi sector in the same way they have pursued many ICO projects from 2017 to 2018. How do you think the SEC could crack down or pursue those in charge of decentralized exchanges or listing DeFi tokens on the decentralized exchanges? Is this even possible given a number of these projects originated outside of the US?
Go
Sorry,
ahead,
Ryan,
Kain.
you can answer that question. No, I prefer if you answered it anyway. So if you want to answer,
you'd be hard pressed to find a less effective regulatory body than the SEC between what they're charged to do and what the actual results are. I don't think that they protect investors. I don't think that they promote fair and efficient markets. And I think they generally impede progress. And that's why people are leaving the US to build some of these applications. So, these battles will take place over years, but I think that the DeFi entrepreneurs have a much sturdier leg to stand on in their defense of some of these system designs than teams that raised $30 million for a 5-person team with the expectation that they would then list their token on a centralized exchange for speculative trading, right? That was so obviously against the spirit of U.S. securities laws in general. DeFi, I don't think it's at all the same with how you think about how these assets have launched and what the requirements are to actually earn fees on these networks. They require some type of active participation versus passive day trading on Poloniex at the time, but Binance or another exchange now.
Kain?
I think that was more than sufficient. Look,
I also have the ability to comment a little bit more freely, so that's why I was going to step in and bail them out. Why don't we go to the next?
Okay, well, it's not fair. Okay. Do you think that, can DeFi in general avoid securities and MSB law implications? Is being decentralized enough?
Those are two very different things.
My sense is that if there's a regulator that wants to regulate you and believes that you are a regulatable entity, they're going to do it, right? There's not really much way to avoid that. And so I think, ultimately with DeFi, what we're trying to do, and certainly, my own personal view, and I can't speak for everyone in the ecosystem, but my own personal view is that I don't have an issue with the intent of regulations, right? It's the actual, the application of them where I think that, at times, like Ryan, maybe, they missed the mark. And so I think the spirit of regulation, to promote fair and efficient markets, to protect, market participants, to have, well-functioning markets is great, right? I think the interesting thing about DeFi is that by creating these very transparent on-chain coordination games, a lot of that is kind of built into the process itself, right? Provided there isn't some central authority overseeing the network or that has some privileged position, everyone's kind of participating with fairly similar understanding of how these systems work. And so I think that the need to regulate something like Uniswap is far less than regulating say either Delta back in the day even, or like a Binance or Poloniex or something like that. They're a very different type of entity, which doesn't mean that regulators won't think that they should regulate them. But my personal view is that in and of themselves, they're a very different type of structure.
Would you like to add something, Ryan? You want it? No. Okay. You mentioned already use cases. Let's get back to that. So DeFi is often positioned as decentralized banking, but the limitation of smart contracts have made it, well, pretty much impossible to add utility to normal people. What are the decentralized and useful use cases that really can appear, and when, if ever?
Well, I mean, I think we've already seen a few of them, right? I think being able to issue synthetic assets, including dollar-pegged, fully digital assets, right? Not ones that are kind of hybrid models like Tether, USDC, or those that are actually custodied in some bank, but truly blockchain native digital dollars and equivalents. The ability to raise money through ICOs and kind of equivalent fair launch systems that we've seen in the last run, and decentralized exchange and with automated market makers. I mean, all of those are 0 to 1 type innovations that are not going to be unwritten. Yes, ICOs got ahead of themselves in 2017. People have been going overboard with some of the kind of speculation around DeFi assets and how they're thinking about their trading on Uniswap and other decentralized exchanges. But the existence of those building blocks makes the entire kind of future financial apparatus much more stable. It's built on a sturdier foundation. So I think the ones that are the next most likely are around additional synthetic asset creation, like what Kain and his team and community have been working on, and with on-chain lending and margin. So anything that's going to lock assets in to crypto protocols for the medium and long term, and keep people either borrowing against them or otherwise leveraging them instead of just treating them as dead assets, I think is a marked improvement. And that kind of goes back to my initial point. Even when some of the crazy 500% annual returns, those will dry up within days or weeks depending on the protocol. But the kind of steady state growth and interest and real fees that you can expect some of these participants to generate it's real, and I think it will keep insiders actively building in the industry, even if it's not necessarily immediately interesting to the same broad audience that we saw in 2017. Arguably, that's healthy.
Yeah, what do you expect?
Yeah, I think maybe I'll put the bear case forward. I think we still have a lot of things that we need to build. We're really not close to a kind of app store like experience, an Uber like experience where I download something, press a couple of buttons, and it kind of all works, right? And there's numerous reasons why that's the case, right? There's onboarding friction. There's just we're generally pretty bad at UX, right? There's not that many people focused on the user experience because we're still focused on the infrastructure. But I do think that there are people out there like Argent and Dharma and other wallets that are trying to kind of bridge this gap and get to a point where someone you can abstract all the complexity away, and someone can just deposit some of their funds and get a much better yield than they can get in TradFi. And I think in the current macro environment, that's maybe all that it will take to get people like I take your point, Brian, that like it's the excitement over 10, 50, 100x returns that like gets people to flood in. But the sustainability of 3, 4, 5% yields over the next 5 or 10 years, while the macro conditions are paying 0 or negative, I think is something that's going to be much more long term and much more stable. And I think we can get there, but we don't have all of the necessary components yet, which is frustrating because there's no good reason why we don't have them. We just maybe haven't invested in the right things, and there's been inefficiencies in how teams have approached things. But I think we are getting close. We're probably 12 to 18 months away from having just a really simple turnkey solution. And we're seeing things like Samsung, building crypto enclaves into phone. Like there's a whole range of things that just need to happen that are not there yet.
Can I catch the word user experience? So who are the users? Who are the community, and how did it change during the last, let's say, months, because it's changing so quickly? I personally see a contradiction there, because in my opinion, the community is at the same time very open to everyone, but at the same time, it's kind of close to those who have financial and developers literacy. So how would you comment on that? And how will the community develop, and how must it develop in order to broader adoption in the market?
I mean, we've got a huge filter right now. Like, it's unusable if you aren't willing to go down the rabbit hole. And like, it's just not something that, even trying to get someone to use Binance, right? Like, I'm telling my parents how to use Binance. It's not easy, right? Like, they're used to using banking apps and stuff. And even still, they're like, what's MetaMask? What am I doing? Like we're not there yet, right? We're just not even close. So I think, you can build for people who are not here yet, right? In the hopes that they eventually come. But I think in most cases, most projects have chosen to build for the people who are already here, which are crypto native people, et cetera. That's just a process that I think has to play out, right? We need that process to play out. But certainly within our community, for example, like everyone is fairly sophisticated. And I think in the DeFi boom or DeFi summer or whatever, where the people came from was not the outside world, right? They were like, Bitcoin, Litecoin, Ripple refugees who'd been floating around for a while, that like all of a sudden something real was happening, and they were like, oh, okay, I'll come and do this thing. But they were already in the crypto ecosystem, whether they were holding some crypto, they'd been through 2017 or whatever. I don't think that we had a huge number of new people join the ecosystem in the last 6 months.
Interesting. Ryan, what's your take on the community and its changes?
Well, I mean, yeah, this one's been all insiders. And part of it is because it's a truly decentralized ecosystem. Binance is maybe for someone's parents that's used to banking apps, it's not the most intuitive, but for most young motivated people that want to speculate, it was a hell of a lot easier to get onboarded to Binance than it was to a decentralized finance application. Because the look and feel is not that different from Square or any trade accounts, and you more or less just point, click, and buy and sell, which is what the last cycle was about. This one, I do think there were some people that kind of flooded in once they saw the amount of money being made, and they would just throw money at basically anything that was getting launched. That was kind of the late part of the cycle, though. I'd say, but before that, you had to be. If you lost money, it was a calculated risk, and to even get to the point where you would lose money, the folks that you're talking about had to be pretty sophisticated in the first place. So, the world's smallest violin, I guess, for those that overextended themselves in this particular run versus 2017, where it was a hell of a lot easier to get caught up in the euphoria and ultimately lose a lot more.
Okay, I would like to highlight another issue. In a lot of DeFi projects, bots and whales control the farming and price action. So basically squeezing out smaller farmers. If we consider DeFi a successful new financial model, what steps do you think must be taken to prevent whales from manipulating liquidity pools and DeFi token price action?
I mean, it's very hard. Capital accrues, its own benefits, right? If you have a lot of capital, you're going to have an outsized impact on an illiquid market. It's very hard to avoid that. I mean, there's certain things you could potentially do, but when you look at the difference between, say, multiple private rounds that were only accessible to insiders, et cetera, versus, someone publishes a contract, the date's announced that you can put money into it. Whoever puts money into it can do so. They get a certain, amount of tokens that are emitted from that. They can hold them, they can sell them. it is a more fair game. I say more fair. It's not necessarily a fair game, right? But it's certainly more fair than, you know, multiple rounds of pre-sales and things like that we saw in 2017. I'm sure that the market is trying to solve these things, and we are seeing, you know, various different types of innovation, like balancer pools and things to get more liquidity in the early days and try and have price discovery be more efficient. But if someone has $50 million and they're willing to throw it into a contract, they're going to get more out of that contract than someone who has $50,000. There's no, I don't think there's an easy way to avoid that doesn't break, market structures.
Ryan, also getting back to our bullish bearish contradiction, do you think that it can somehow, the steps that we can take can somehow influence the overall development of the market?
You have to be careful what you wish for here, because you say manipulated markets, and I say Wild West, and I think it's arguably a good thing that some of these nascent markets are manipulated, and that some of these games are being played, because ultimately there should be some solutions that emerge that help fix some of these problems, or you come up with the crypto equivalent of poison pills and protective provisions that you'd expect in with certain public companies as they think about their equity and defending themselves from attack, or hostile takeovers or things like that. So you don't know exactly how it's going to work out, but there has been some experimentation around that so far. Maybe not necessarily in terms of reining in whales, but with Uniswap, essentially penalizing any of the folks that migrated liquidity to SushiSwap. The folks that just proved to be outright mercenaries and looked like they were going to siphon off all demand from Uniswap, ultimately lost out on the bigger prize at the end of the day. You can see behaviors like that are defensive in nature being replicated and systematized going forward. It's not like people will just throw their hands up and say, well, there's too many whales in this market, so I don't really have a chance. There's always going to be someone that's looking for an angle. That person will make money, or that team will make money, and it'll be a natural game of cops and robbers until the market's much more efficient and kind of provably transparent and safer. And in the meantime, you'll probably be able to insure against some of that as well through derivatives and other actual insurance products that are based on-chain transactions and the sophistication of the underlying libraries, like we've seen with Nexus and some other early stage insurance protocols.
Okay, what's your take on the belief that profits from the recent DeFi and altcoin rally will or have moved back into Bitcoin? Also, is it good or is it bad? And how can it influence the development of the market in the future?
Everything rotates back in Bitcoin.
Yeah. Look, I think there's a little bit of maybe coincidence here in terms of timing, right? That's my intuitive sense. Look, no one knows what the fuck is going on at any time, at the best of times, right? But I think in this case, like the fact that Bitcoin is rallying as some of these DeFi projects have corrected feels like a bit of a coincidence to me. I don't think you can move Bitcoin as much as it has moved in the last couple of weeks by the $10 billion in market cap of the total DeFi tokens, right? I just don't think that that's a thing. If anything, I would have expected more to move into ETH, and I think the fact that kind of hasn't happened, or ETH's even moving into BTC, like it feels like they're somewhat unrelated. But there's no question there's a lot of capital that is sitting on the sidelines, either in stable coins or in high cap alts, that's been pulled out after this cycle, right? Like it's just, there's money sitting on the sidelines, and you're seeing it, be deployed as the corrections kind of happened. A lot of dips being bought up. So I think there's a number of things going on, but there's also, if you flip it around, there was quite a bit of Bitcoin, I think, that actually, towards the end of this DeFi cycle went into DeFi tokens. There's no question that was going on, right? For yield farming, for buying tokens, et cetera. So, that capital that left Bitcoin to come and play in DeFi land, you'd expect a significant portion of that would probably flow back out as the music stops.
Ryan, anything to add?
Bitcoin dominance is, it has been a yo-yo for years. And I think if Bitcoin ever gets up to 90%, that's when you should buy alts. If it ever gets down to 50%, that's when you should buy Bitcoin. And it's kind of stayed in between that range for quite a long time. But I think with everything that's going on in the world, Bitcoin's going to have to lead this rally because in 2017, you could make an argument maybe in the beginning of the year that Ethereum led that rally and the kind of emergence of ICOs. And then Ether was the reserve currency for these ICOs. But in the back half of the year, that wasn't really true. The reserve was, the quote currency was Bitcoin on all of the exchanges that were going through the roof in terms of volume. So, 2013, 2017, I think now it will be all about Bitcoin. No one is singing songs about Ethereum, for better and for worse, mostly, for better. But no one is really taking it seriously out of, deep pocketed investors that can actually move the needle from in Ethereum's case, $40 billion market cap into the hundreds of billions like Bitcoin already is. If everything rotated out of alt currencies, and into Bitcoin, it's not going to have an outsized impact on the Bitcoin market. The reverse is the exact opposite, right? So these slow and steady kind of eras of consolidation, where the altcoin holders experience a lot of pain, is to Bitcoin's benefit. But I don't think we're in that environment right now. If the world doesn't implode, then as Bitcoin goes, everything else will follow, and it will be much more insane what happens to alternative assets than what happens to Bitcoin.
And according to you, how Ethereum's dynamics can influence the DeFi market?
Again, like I was somewhat, I still hold Bitcoin. I still, I have a very, I have a fondness for Bitcoin, right? But obviously I live in Ethereum land, and that's the network that I use every day. I don't do that many Bitcoin transactions. It's just kind of, in fact, most of my Bitcoin is now on Ethereum. So when I move BTC, it's as REN BTC or TBTC or sometimes wrap BTC. But this narrative that's emerging of, hey, you've got a giant pile of cash, and cash is not the safest place to have your funds right now. I think is a very, very powerful narrative for Bitcoin, and it kind of just came a little bit out of nowhere, right? And so, I think that narrative is an easy narrative. This store of value, digital gold narrative is really easy for traditional investors to get their heads around. The idea of Ethereum as this, settlement layer and computation layer for decentralized finance, we're not there yet. We haven't advanced that narrative enough that like institutional investors are really ready to kind of even grasp what that means. So I think there's quite a bit more time before Ethereum is going to have that level of brand awareness. But there's no question in terms of what's happening, the kind of activity in the ecosystem, it's all happening on Ethereum. All of the activity is there. So there's this weird dichotomy where, Bitcoin has the most brand awareness and it's the easiest to grok, but it's not necessarily where everything's going on and where the effort is being put.
Okay, so is it in the end a rising tide lifts all boats situation? So like BTC price rises, Ether price rises, Alpha
100%.
and DeFi rises.
Absolutely.
Or also, is there another trigger that can catalyze the next DeFi rally?
I think, you know, Bitcoin going up, you know, is the thing that is going to bring most eyeballs back into crypto. You know, and I mean, we, like Ryan, you know, and I both kind of agreed on this. I think that, you know, this DeFi summer was all crypto insiders, right? I don't think any new people turned up and were like, "Hey, I've heard about this DeFi thing," or very few, right? Whereas, you know, BTC hits 20K again, we're, you know, back in a different reality where all of a sudden it's on, you know, mainstream news and there's headlines and, you know, we start to see all-time highs again. That didn't happen with DeFi. There were no, you know, front page articles about DeFi in the New York Times. Like, that was just not a thing in the last 6 months. Whereas you will have that with Bitcoin, and that will drive a lot of awareness.
I think, look, I own Ether, you know, I own a few other assets aside from Bitcoin. Bitcoin's still, you know, lion's share of my personal portfolio. But, you know, I don't know about you, Kain. I mean, I don't see a scenario where Bitcoin doesn't eclipse its previous all-time high. Like, I can't conceptualize 100%. It, right?
Yeah, agreed. Yeah.
I can wrap my head around that being the case for Ethereum, right? Could Ethereum ever hit 1100 again? I could, not that I think it will not, because otherwise I would hold it. But I can see multiple scenarios where it never hits that all-time high again. Even if it's, you know, less than 50% probability. There are other functioning smart contract platforms. There are layer 2 solutions that, you know, are going to siphon off kind of settlement demand on Ethereum. There are other application-specific blockchains that are going to siphon off specific types of contracts from Ethereum. And ETH2 is not a foregone conclusion, right? It is a very massive undertaking. That the contributing teams have you know, gone to extraordinary lengths and you know, done some incredible research and work behind supporting. But at the end of the day, it's not, you know, until it's done, it's not done. It's rebuilding an airplane in midair. And, you know, Bitcoin has never had something as similar. The closest that Bitcoin had was arguments over backwards compatibility for a 1 megabyte increase in the size of block size transactions, which is such like it's so far in the realm of like esoterica for anyone that's just coming to the debate. If you understood the underpinnings, you understood how important that was as a design choice, maybe in hindsight, because it hardened and ossified the core use cases as a very sovereign resistant, you know, form of digital money. But there's no other kind of unifying narrative or kind of definitiveness around Ethereum or any other crypto asset that I can think of that, you know, just has me 100% convinced, no doubt, put my life savings into it, that the asset will ultimately eclipse and far surpass its previous all-time high. And so I think that's where, you know, we start thinking about substitutes. And to Kain's point, he spends all of his time thinking about Ethereum. Quite frankly, so do I. I spend next to no time thinking about Bitcoin because I know it's not going to change, and I know it's safe, and I know if the macro environment plays out the way that we think it could, then that's going to be one of the, you know, safest and smartest investments, or at the very least a very smart hedge for what's going on a macro front. The reason we spend so much time on Ethereum is because there's so much new innovation. There's so many new applications built on top. Yes. But also because there's so much going on the fucking base layer, and you want to make sure that like whatever you're building on is not a house of cards, and that you've got kind of redundancies in place to move to other similar platforms. Because even if Ethereum had its struggles, you will, and we've already started to see some applications moving to other chains. Or another very easy to visualize future of the world is, you know, maybe Ethereum is the winner or the plurality winner out of the smart contract platforms. But that's not to say that all of these systems don't interoperate and talk to each other, even with currencies, right? I don't disagree. Bitcoin is great money, even if it's on Ethereum, and that's, you know, proven to be the case. So I think, you know, the long and short of it for me is, you know, as Bitcoin goes, so goes the industry. But as any other protocol, any other asset goes, it's all just part of the test net and sandbox phase of building out this entire smart contract ecosystem.
Okay, I think we need to wrap it up. So my last question will be your long-term trend prediction, bullish, bearish, and how, in your opinion, it could and should influence the global distribution of wealth. Keeping in mind that we were talking about crypto natives in the community, keeping in mind that, well, I'm interested especially about bullish approach to the market and how it can make the world better in terms of distribution of wealth.
I mean, even if you look at Bitcoin, right? Like the idea, the sort of concept that money printing benefits insiders in the, money printing process, right? The closer you are to that, geyser of bills that are spewing, out of central banks, the better off you are, right? That's just a very bad place for the world to be in, I think, right? We shouldn't be optimizing for who can get access to, central bank money printing, and fighting over, who's the beneficiary of inflation. And so I think that, hardening these systems and making them more transparent, making them more open, is in and of itself, a huge undertaking, but an amazing goal, right, to be aiming towards. And I think Bitcoin fits into that, right? It is a part of that. But from a functionality perspective, from, rebuilding a lot of the financial infrastructure, you really do need smart contracts. Bitcoin, like Liquid aside and Lightning and, some of the other things that have been proposed, you really need that kind of, ability to program money to be able to compete with traditional finance. Right. It's one thing to have a store of wealth. It's another thing to be able to actually process all these different things. And so I genuinely believe that that's our goal. It's certainly my goal to try and supplant these traditional systems they're inefficient and much less fair. Can we do it? I don't know. There's a lot of headwinds, right? Like look at Bitcoin, it's taken 10 years and, it's got a little bit of cut through, but, it's still got a long way to go, I think, before, it's kind of expected that everyone holds Bitcoin in their portfolio and, it's indexed to all of the stuff that we kind of think might happen. I think we're, an order of magnitude further away when it comes to smart contract platforms and really replacing the financial infrastructure. So it's not that I'm bearish. I just think that we're taking on a very, very difficult challenge. And there's a lot of entrenched interests that want us to fail. And at the moment, they don't even need to bother to try to stop us, right? Like we're not even close. We're not even at the point where they're like, okay, we're going to come in and really stop you, right? So, I think the hardest part of this journey is still very much in front of us, which is kind of a scary place to be. But ultimately, we're headed in the right direction. We just need to kind of push through it. That's my belief. But it's going to be hard. It's going to be very, very hard.
Ryan, your long-term beliefs and predictions.
I don't have a whole lot to add there. I'd say I'm a believer in most of these technologies and their potential. The path to get there is not a straight shot up. I will add that I do think there's going to be a catastrophic DAO-like implosion at some point in the not too distant future. That's the result of kind of cascading leverage in the DeFi ecosystem. And maybe the perfect way to look at this is what happened in March during kind of middle of the COVID crisis and kind of the worst of that liquidity shock that hit the entire macro economy. BitMEX shut itself down or went offline, whatever euphemism you want to use, but basically, had that not happened, we could have seen Bitcoin temporarily touch $1,000, maybe even less. There, I think, will be some similar incident that happens in DeFi, particularly as some of the major protocol teams and operators cede administrative control of their libraries to DAOs and actual decentralized ecosystems. I think some people have derided the whole concept of a kill switch or an admin key from the part of a team that's developing one of these apps or underlying platforms. And the reality is, if you don't have that, then you're kind of at the mercy of the entire system's weakest link. And historically, that's not been the safest bet to make in crypto. So I don't necessarily think that's a bad thing. I think the scale of that wipeout will depend on a confluence of factors. How sucked in people get to different schemes, just how much infrastructure is built on top of each other, and generally speaking, how quickly the security engineering teams and kind of audit firms are able to build bulletproof libraries that become kind of de facto standards. All of that's happening to a certain extent, but it's so early, and as a result, the developer ecosystem is so immature. There's some great developers, but it's by definition a very, very small fraction of the global talent pool. So I'm convinced that there will be many smarter people that look to exploit loopholes, in some cases perfectly legitimately, in order to make money just playing by the rules of these systems. So and by the way, that's happened to a certain extent. There have been attacks that have not really been attacks. They've just been good gamemanship where people have executed fast loans and rapid transactions that kind of siphon money from one protocol or another, and just play by the rules of the game as they were written in the smart contract. But if you do that at scale, and it creates a liquidation event on Maker or any of these other critical building blocks, I think that could set back the industry for quite some time.
Fantastic. Thank you very much, guys, for your insights and thoughts. I just can tell that according to our backgrounds, bulls, bears, and also those who make them talk, all love music. So this is a great sign, and music will save the world along with the decentralized technology. Thank you very much. Thank you, BlockDown, for inviting us.